Welcome to Human Risk, a podcast dedicated to the understanding of human behaviour as a risk. Here's your host, Christian Hunt.
Hello and welcome back to the Human Risk podcast. On this episode, I'm exploring a topic I've covered before, misconduct in the banking industry. It's a particular interest of mine, partly because it's a sector that has provided and continues to provide plenty of examples of human risk in action. It's also the place where my human risk mission began. If you're new to that, you can find out more at human-risk.com. My guest on this episode, Barbara Casu, is well qualified to help me explore misconduct in banking. That's because she's a professor of banking and finance, and she's been leading some fascinating research into how misconduct might be prevented. In a recent paper, she explored whether changing the composition of bank boards, in particular having greater female representation, could be seen to reduce the level of misconduct. You don't have to be an expert in the sector to note that historically bank boards have mainly been the preserve of white males. Logically, therefore, making them more diverse ought to have an impact. And it does. In her recent paper called Gender Diversity in Bank Misconduct, data analysis by Barbara and her colleague Dr Angela Gallo suggests that banks with strong diversity at the top were more compliant and tended to avoid the same level of financial punishment compared to those with male-dominated boardrooms. Having read the research, I wanted to know more, so I asked Barbara to join me on the podcast, and she kindly agreed. So here, with her insights into how gender diversity can be a powerful tool in reducing human risk, is Professor Barbara Casu. Barbara, welcome to the Human Risk podcast.
Thank you, Christian. Thanks for inviting me. It's a very interesting topic, and I'm delighted to be here.
It's so great to have you here. Now, I know who you are, but it would be great if you could just give my listeners a little bit of introduction to you and your area of research.
I am a professor of finance at the Business School of City University, and is the business school that was formerly known as CAS, but we are in the middle of changing our name for a reason that might become more obvious in the coming minutes. CAS Business School used to be the name of the business school. And there, I am also the director of the Center for Banking Research. So all my interests are in the area of bank regulation, competition, particularly in relation to European banking, looking at various aspects, including the governance of banking institutions.
Fantastic. So bang on the industry that I know well, and clearly an industry that has displayed huge amounts of human risk in action. And you recently published this piece of research that I just saw the headline of, and it found me nodding vigorously, and I was really keen to read it and read it, and you confirmed quite a few things that I thought intuitively must be correct. But before we come on to discuss that, can you just outline a little bit what was the research covering and what was your impetus for starting it?
The impetus for starting it is a new project that is the Conduct Cost project that has recently transferred from the CCP Foundation to the Business School under the remit of the Center for Banking Research. And the Conduct Cost project is collecting the data on bank misconduct, particularly of large banks across the globe. And the idea is to have a little bit more transparency on what type of fines and what type of breaches financial institutions are subject to. And what we know from the financial crisis onwards is that financial regulators and supervisors have paid a lot more attention to the dealings of banks. And we had these huge scandals from the PPI scandal, mis-selling in the UK, to the LIBOR scandal, to the scandal on fixing of exchange rates, to various other scandals, including anti-money laundering and breach of economic sanction. So this is the remit of the project, to increase transparency, because most of these fines are available, but you need to collect the data from different organizations, supervisors, regulators in different countries, in different languages. So the aim of the project is to increase transparency on the conduct of banks so that we can kind of encourage a better conduct. If you could produce a league table of how well or how badly banks are behaving, not only in terms of their return on equity or their profits, but also on their conduct, the idea is to foster a better behavior in the financial industry. and for certain a more transparent behavior. And as you probably know very well, this idea of conduct risk has become more and more important. So it's not just market risk or operational risk or interest rate risk, conduct risk. And the reputational risk to financial institutions is really pretty high in everyone's mind. The other thing I'm really interested in is gender diversity in finance. Being one of the few women professor of finance, not only in this country, but globally, I know how difficult it is to achieve gender equality. What are the obstacles? What are the constraints? And one of the least diverse industry we have is the financial industry. And in particular, the banking industry. You will agree with me, particularly at the senior level and top level of management. And again, the financial crisis has shown that there was very, very little diversity, and that can be causing all issues in corporate governance. And one of the recommendations post-crisis was to increase governance, started from the board of directors, which is one of the things regulators can not control but have a say. And then we have seen a series of reforms, some encouraging more diversities, like Women on Board 2020, the Hampton-Alexander Review in the UK to encourage reaching a 30% female participation on board of listed companies. And some countries have gone even further, trying to impose gender quota. Italy, France, even the state of California in the US, they have tried to impose gender quotas. But this is not universally agreed. There is a lot of controversy saying that once you impose gender quota, the performance of the firms decreases because you have to give roles to people, women in this case, that are not qualified, that don't have the time, that they don't have the skills, they haven't done the career. So overall, you decrease the monitoring role of the boards. And what we started to think is that most of the studies looked at a very short time period after the reforms. And every time you change the settings, in this case, the composition of the board, there is some adjustment time. So we wanted to see if we were to take it into account a longer time period, and we have the 10 years following the financial crisis. And we looked at the evolution of female presence on boards as board members and fines, if we could find that women on board meant fewer fines.
Just to unpack this for people who aren't familiar with the industry. So you basically said, okay, there's a heck of a lot of things that we all know about going wrong in financial services. Hence, regulators fine the firms as a sort of as a means of punishing them, but also to deter that. So you started to look at, so what are the other tools that go alongside these fines? And one of the things the regulators identified was there was a lack of diversity on boards. So the logic simply being that you end up with kind of things like groupthink and maybe a bit of sort of testosterone fueled machismo would lead firms to take greater risk than they might do if there was the greater diversity. So what you're starting to look at here is to really say, okay, this is one of the measures that financial services regulators have imposed to try and get this change. And therefore, is that actually working? Can we see that happening? And therefore, your test is really to sort of go, okay, so theoretically, that ought to solve the problem. Different ways of thinking about things sitting around the table. Does it actually work?
Yes, there are a couple of things that I need to add. The first one is if you simply look at the fines and the presence of women, the only thing you see is a correlation. What we were interested in finding was a causation. Can we really say that a higher presence of women can explain this? So to do this, we have found a way around it, if you want, and we are concentrating on the fines imposed by US regulators on European banks. Why do we do so? Because there is a lot of, if you want, regulatory capture in banking, as you might know, which can be driven by political connection, might be driven by negotiation, might be driven by the CEO being an old school friend of the regulator. or the regulator moving to become the new chief of, risk officer of the bank. So our assumption is, if we want to believe that US authorities have a much more distant link to the boards of European banks and have less inclination to be lenient towards European banks in the way that they could be towards American banks, then we can kind of break this possible channel of political connection and regulatory capture, and then we could potentially be better at isolating the impact of women on the board. So this is why we focus on US fines on European banks. The reason why we can do this is because we have discovered that US regulators can fine any banks anywhere in the world. They don't have to be located in the US. They don't have to be US citizen. As long as any transaction is cleared in dollars, that gives them the jurisdiction to impose a fine if they breach any of the regulators. So they have quite a lot of regulatory capacity, because the large majority of transaction of these large international banks is cleared in dollars.
And so the way, just for listeners that are unfamiliar, and correct me where this is wrong, Barbara, but the logic here being, okay, ordinarily you would think I only have jurisdiction over you if you are present in my territory, because I can then regulate what you do. The way this operates is that the US regulator has that further reach, because if you're doing basically clearing US dollars, which you need to do transactions, they can use the fact that you're using their currency to put, and I'll keep it very, very simple, to put pressure on you through the banking system. And therefore, they have a global reach that other regulators wouldn't have because of the strength of the currency.
Precisely. That is exactly it. So that's how we constructed our empirical experiment. We look at the fines imposed by US regulators on European banks, and we check whether changes in board composition help explaining this. So we look at the number of women on board and the changes in the number of women on board over this 10 years period. What we know is that there are different theories that try to explain this relationship, and we look for the mechanism that can really drive this. The first one is that women are better at monitoring. They pay more attention. They attend board meetings more regularly. They are more likely to ask questions, and simply the presence of women through this heightened monitoring role can mean less fines. But then we wanted to go beyond that, and we wanted to understand what explains these differences in behavior. And the academic literature gives us two different theories. The first one says that women are intrinsically more ethical. And the second one is that women are more risk-averse. The ethicality theory is often backed up by the gender socialization theory that says that women are socialized from a very young age to be nicer, to be more interested in the well-being of others, in helping out, in not being loud, not being bossy, not being complaining, and therefore take everyone else's interest into account. I know there are people that would disagree with this, but this is what the theory tells us. Whereas men are often socialized to be the winners, to be first, to be competitive. So a competitive man is rewarded, a competitive woman is unrewarded. And that can kind of explain differences in women have a broader view and they take into account all stakeholders. Men have a narrower view and take into account profit making. You can agree or disagree on this view. The second view says that it's not that women are intrinsically more ethical, they are simply more risk averse. But it's a different view of risk aversion, because what you need to think is that all these women have already made it to being board members in large banks. So they are not your average. But the idea of risk aversion is linked in our study to this idea of a gender punishment gap. So for the same kind of misbehavior, for the same kind of misconduct, the penalty for women will be a lot higher. And this is proven in the literature. If you look at traders committing the same kind of infraction, women are a lot more likely to lose their jobs. Men are a lot more likely to just get a ticking off. And even if they both lose their jobs, women are more likely never to get hired again, whereas men get hired again. So this was the idea that we were trying to understand. Was it women were really more ethical, so that the behavior is different because of, intrinsic characteristic and differences between men and women? Or was it that this idea that, if I commit a act that I shouldn't, I get punished more compared to a man, the stigma is higher, the punishment is higher, makes me more risk averse and therefore more likely to play by the rules.
Fascinating stuff. So much to unpick in thinking that's gone into this. Because what I find it fascinating, when you look at the regulatory measures that were imposed, it didn't strike me, and feel free to tell me this is wrong, that the regulators had gone and done a massive amount of scientific research. This was part of a series of measures. What can we do? And one of the things that we can do is we can look at, because we're engaging with the boardroom level as a regulator, we can say, it doesn't look particularly, that would be a quick solution to it. And what I think is fascinating is you've gone back and gone, okay, let's really understand the logic as, what dynamics might women bring into the boardroom? Yeah. What possibly? And then let's explore whether that happened. And so it's in many respects, as you rightly point out, you don't necessarily need to agree with all that research. And I know there will be some, men listening to this who'll go, that's an outrageous slur. And I kind of go, well, that's interesting because you're not saying, you weren't sort of sitting there saying to regulators, this is why you should do it. The answer is simply regulators have done this. And it has happened, and possibly firms have done it of their own volition to a certain extent as well. For other pressures, it's not necessarily all to respond to regulatory pressure. But those are the sort of arguments you say, these are the hypotheses based on what we know about how men and women think as to why there might be a difference if you were to put women in the boardroom. And then, so that's your sort of basis of theory. And then what you've done the fascinating bit of saying, okay, well, how does that play out? Can you just share a little bit with you what you discovered when you looked at this dynamic? I guess for question number one is, did the presence of women on board see a reduction in fine? Did that actually flow through?
Yes. So that is a resounding yes. And that results holds in different tests and different specifications that we carried out. So the presence of women on boards decreases the number, the frequency of fines and the severity of fines. So if there were more women on board, what we find is that it would decrease fines on average by about $7.5 million a year. What we also find is that if you only have one woman, you don't find this strong effect. You need to reach what is known in the literature as a critical mass. So for women to have this impact, to change the dynamic of the boards and to have their voice heard, you have a minimum number of women, which is about 3. So out of a board of directors, you need at least 3 women for this effect to be reinforced. And the other thing we look at is this: if this effect is stronger, if the women on the board are also joined by women in leadership position, being a CEO or the president of the bank. Unfortunately, women CEO of banks are very rare. Across our sample period, we have only about 7% of our banks which are led by women. Now we have, Alison Rose, that finally is yet again another woman leading a large bank, but they are very rare. So we try to increase this definition of women in leadership role by looking at the president, looking at the chief risk officer, looking at the chief operating officer to try to see. And we do find that the presence of women on board becomes more significant if there are also women in top leadership position. So the key takeaway of this part of the analysis is that, yes, women decrease misconduct, the frequency of misconduct, but you have a stronger effect the more women you have, at least 3, which is the critical mass, and women in leadership roles. So if you expect one woman to change the dynamics, that's not going to happen. That's, tokenism.
One of the things I find fascinating about this is that if you look at, there were decisions taken in firms where it was clearly in the boardroom that the error was made. But in plenty of cases, it's people on the ground throughout the organization. And of course, in banking, you can have very junior people in positions where they can cause problems. So if I think about sort of traders, by any stretch of the imagination, the sums that people can play with, and I'll use that term intentionally, are quite. So it's fascinating here that you're demonstrating really that the tone from the top piece really does work. Because you could say, well, okay, it's fine having them at the top, but actually if you've got, because diversity within these firms is still not at a level that reflects society as a whole. So what's interesting here is that you're looking at an intervention, for want of a better phrase, at the highest level of the organization, and that genuinely does filter through. So there's a real illustration here of tone from the top matters.
I absolutely agree. The tone of the top at the top matters. And what we demonstrate is that women have a really important role. Because one of the questions we were also asking, is it because they are women or is it because they simply increase diversity? So, and that is, again, is the diversity of views, is the fact that you avoid having a silos view, or is the fact that they are women? So we went into details to try and answer this question, and we collected data on age difference. So you can have, a 35 years old millennial in the same board as a 65 years old boomer, if you want. We collected data on whether on the board there are employee representatives, because in some countries this is compulsory, for example, in Germany. And again, having employees representative may bring a variety of views. And the last thing we look at is the nationality of board members, to try and understand whether different views of board members coming from different countries can also have this impact. One thing that we would have liked to collect, and we couldn't with the data we have, is the ethnicity and racial. You cannot racially profile. It would have been a fantastic way of trying to disentangle this, but for obvious reason we couldn't access this data. So we don't know if ethnic diversity has an impact on this. So this is one of the limitations of our study, where we cannot do that. But what we find is that even if we look at different types of diversity, gender diversity is still dominant. So the impact of women is strong and remains strong even when you account for different diversity. So there is less of a difference between your 35 years old and 65 years old, particularly if they went to the same school and they belong to the same social class and they have the same circle of friends. And then you can find in these differences in gender to try and bring different views.
As you talk there, I mean, I find it fascinating when I think about one of the criticisms, if you like, that people would have of just looking at raw numbers is to say, well, actually, one of the things that it sometimes takes for women to succeed in certain careers, and politics would be one example, banking is probably another, in many respects, is to develop male attributes. So to become very aggressive, very pushy. So I think of Margaret Thatcher would be a good example of a sort of character you would assume. And so one of the interesting things is sort of, and partly based on personal observation. So listeners that have worked with me before may know some of the people I might be thinking of. But it's, you can see this sort of, the way that you get to senior positions in those sorts of organizations is to behave like a man. And what's interesting is implicitly your research basically seems to suggest that's not as much of a problem as one might think. In other words, that you've got the visual diversity, but actually if they think in the same way and behave in the same way, and they are, replicating the male dynamics, that you seem to be suggesting that that's not such a big issue.
I am suggesting that this is not such a big benefit. So if I stop behaving like a woman and I start acting like a man to progress in my career, if this is what, the company ethos is telling me, that to, be promoted, I need to push certain behavior and compress certain other behaviors. So I am not supposed to be compassionate. I'm not supposed to, take time out to care for my children or any other things. Then the women that will eventually progress through the career ladders are those that are more willing or more in terms of their personality behaving like men. So you might tick the box of gender diversity, but you don't have real diversity. So what I am trying to say is that if you want this benefit of diversity, benefits of broader views, benefit of someone calling out a behavior that they feel that is not appropriate, or a behavior that makes them feel uncomfortable, you need to maintain this diversity of views. And this is something that I think organizations are still struggling to manage, because everyone is promoted according to rather rigid criteria. You need to meet your targets. You need to meet your sales. For academics, you need to make that many publications and get so much in research grants. And they are very standardized ways of rewarding. And they are pretty much reward system designed by men fitting the way that men work. And sometimes they don't work for women. And then you have this, we call it a leaky pipeline, where you have a lot of very promising 20-something and 30-something that then they face so many obstacles and the ability to act in the way that is in the way they are, that will drop out of the industry. They will think the industry is not for me. We have not managed to change the mentality of senior management and change the way people are rewarded in their careers.
And I've never heard that before. I love that idea of a leaky pipeline, because it's fascinating, because a lot of effort is being put in the recruitment phase. And particularly when one thinks of organizations that grow from the bottom. So graduate intake would be a good example. You're right. There's a huge amount of emphasis placed there on broadening that particular piece in. And obviously, if your solution to this particular problem is to let people grow up through the organization, one, that can take some time, because obviously it's not, you don't, much as it's shown in the movies, and there are occasional examples where this happens. It's very rare for somebody to shoot up through the ranks. And actually, we've seen the downsides of that, particularly in trading environments where people have been promoted very, very quickly, because you had to do that to give them a bigger trading book. Actually, so in most cases, there's a sort of slow lead time. And you're right to the extent you can have the pipeline in place, but if it's leaking the wrong people, that's a challenge. So when you look at sort of the composition of boards and some of these pieces, I mean, there's an interesting thing that says, because you're able to look at this time period where there have been, I'm not going to call it substantial changes, but big enough changes for you to monitor, partly through, as we said, the regulatory piece. Have you looked at in terms of how that is happening? I mean, is this people being pushed up the ladder quicker to get there? Is this people being parachuted in from the side? How are companies solving that problem? And what does that mean?
Okay, that is a very important issue, because the feeling and some of the kickbacks that normally these initiatives have is that people are plucked out from middle management roles or from other careers to fill these board places without having the necessary experience. And I know in other countries, board members are normally called in from different industries, sometimes even from academia, because there is a scarcity of women in key roles. But that shouldn't really stop the initiatives. What I feel, and that's my personal opinion, what a lot of these initiatives should look at is really the middle management stage, which normally coincides with women being in their early to mid-30s, which is when you start taking maternity leave. And then a lot of women don't manage to come back. And therefore, there is this leaky pipeline. So you can have all the efforts put in to encourage women to come and study economics and finance at university. And in my postgraduate classes, you would think that it's not 50-50, it's still mostly men, but you can slowly go towards a 40-60 composition, which is different from where we were when I started 20 years ago. And then women do start jobs in finance. My students do apply, but then 10 years later, how many of them are still in finance and how many of them have moved to different roles, consultancies, part-time jobs, and therefore they don't make it. That is one thing. The other thing is, what type of characteristic do you want from a board member? Do you really want someone that has gone through all the, career ladder and knows the institution, or you want someone that is able to have a broader view, that is able to bring a different insight, someone that is able to ask difficult questions, sometimes because they don't understand exactly your business, but they, are able to ask these questions. So again, there is an issue of competence, an issue of age, an issue of coming from different fields, and it's about trying to be a bit more open-minded as well.
And I'm fascinated by this point around experience, because I think there's lots of reasons why experience within an organization or indeed within an industry can be really powerful and good. So you understand the ways and means, the way things operate. So there's a traditional logic that would say the longer you've been in a particular industry or particular company, the more you'll understand the DNA, how things operate, the realities, you'll have it. Experience is valuable. The flip side, and I think COVID has added to this, sort of says, actually, that doesn't open you up to new ways of thinking about things. You assume that the way that things have always happened is the only way and the right way to do things, whether this is explicit or implicit in your thinking, and you're kind of institutionalized. And, just the word institutionalized is often used as a criticism. And if we look at COVID, I find this interesting because, you might have grown, let's take banking as the obvious example. You might have grown up through a business that historically, was all about cash and physical buildings. That's become a digital business. You may have grown through this thing, not really picking up you're not a digital native, you're a digital immigrant. You then factor in that you're used to working, if you're running a trading business, maybe you had people in one physical location you were managing, and you're now running a business with a distributed workforce that's operating digitally that has things like Bitcoin. It's a whole load of dynamics where past experience is not necessarily helpful for navigating some of the challenges today. And I think that balance is really, it's an interesting one. It's quite difficult. And many of the arguments that I think have been used to sustain, why do we appoint this person? It's using all those legacy arguments that says they've grown up with this stuff, they really know what they're doing. And I think it's worth challenging that in the current environment to say, is that past experience worth as much as you think it is?
I think is an important trade-off, because sometimes even unconsciously, we all have biases. So no one is free of biases. And the way things have been done in the past kind of informs you the way you want to do them in the future. And, even in my fields, the move to online teaching has been met by incredible amounts of resistance that I don't teach online. I don't like this. But then once people have let go of this initial fears, inhibition, then it's been embraced, and people are actually realizing that there are some positives, there are some good things, could open up different ways of reaching and educating people in remote locations. So you can see the upside, whereas, at the beginning of the first lockdown, you only saw the downsides. But going back to your question, experience and competence are important. Absolutely. But I also believe that you need a good mix of skills. And sometimes your experience and competence stop you from asking the right questions, or the inconvenient questions, or the questions that sounds obvious to an old-timer. But then when you try to explain it, you realize that maybe that's not the best way.
Yeah, it always amuses me because you sort of, if you ask senior people, so there's this concept of value at risk in banks, which is a risk management, which is everybody basic principles, sort of how much are we risking here, but underpinning it is a whole load of maths and complicated things that I suspect many people in senior positions don't understand. And I think it's really interesting because it's used as a risk management tool. And everybody sort of understand. And there are some people that really understand the detail, but you're right. In many cases, they'll sort of, you get to a sort of level where the understanding might be a 3 out of 10. And that may be all that's necessary, but you start, and I think this idea of questioning conventional wisdom, I think is really interesting and plays into precisely where the value add of having different perspectives is, because actually, if you've been in an institution for a long period of time, there are questions you're not you feel like you can't ask. And building that courage, I think, is interesting. And so I'm fascinated by your thoughts on the dynamics of having women in the boardroom. So you've said they're more empathetic, they are more risk averse. Some of these sort of, that's the theory of, did that manifest itself in what clearly you're not sitting in the boardrooms observing how they operate. And we all know that minutes aren't necessarily an accurate reflection. But do you have any sense of, are these traits actually manifesting themselves either visibly or invisibly, or is it just a sort of broad sense of bringing something different? Or are these attributes that you referred to before, are they the things that we've started to see coming through?
Okay, there is quite a vast literature that proves that women are more disciplined. They tend to attend board meetings regularly. They tend to arrive at board meetings more prepared. They tend to not just wing it. Maybe a collegial sense of insecurity makes women over-prepare on average, because they read the minutes, they read the document, they ask the questions. Whereas I have met a lot of people that just come into the meeting, they think they're going to wing it, they think they are going to just make it, and they have absolutely no idea of what the board documents are about. So there is a little bit of that that comes, if you want, from insecurity, from the fear of being not up to the job, from the fear of being, sometimes considered not qualified enough, that makes you over-prepare. So there is a literature that shows that. What we do in our studies, we look at something slightly different. So we try to test this ethicality channel, and which is a channel that was contested when we presented this paper in various conferences. You can imagine not many people wanted to buy our story that women are more ethical. But to test this, we look at the difference between criminal fines and civil fines. And we argue that a criminal fine is less ethical because it entails a jail sentence. It entails a willful decision to commit a crime, and is normally much higher in fines, whereas a civil fine can be some, tax discrepancies rather than something different, which is still serious, but if you want, less unethical. And what we argue is that if women are really more ethical, then we should see a biggest decrease in criminal fines. And we do find that, but the result is not super strong. So we do see that women seem to be more important in decreasing criminal fines, but maybe because there aren't that many criminal fines in banking. There are, but not that many. So we were not pushing this idea too strongly. So the next thing we do, we look at the market reaction. So the idea is, if women are most concerned about what other people think, if they are more concerned about this idea of a gender punishment gap, then they would react and intervene and decide to monitor more closely in those instances where the fine can have a higher reputational risk. So we distinguish the fines in different categories, looking at, for example, economic sanction, anti-money laundering, taxation regime violations. And we check for the market reaction when these fines are announced. So we know that. So
it's not just the quantum of it. It's literally what impact is this having beyond the pure financial one?
What impact is this having on the share prices? So the day that the fine is announced, and in the few days before and after, how is the share price of the company behaving? And the idea is that the biggest drop in share price means that the market is penalizing the bank more for a particular type of fine. And what we find is that markets seem to penalize banks in a harsher way for breaches of economic sanctions. So if a bank breaches an economic sanction, then the share price will drop substantially. It will then go back up, but the immediate reaction is much harsher than to market manipulations, incredibly. So since we found this result, then we test whether women have more impact in reducing this type of fine. And this is what we find. So for the fines that are perceived as worse by investors, by the market, by shareholders, the presence of women manages to decrease these fines even more.
Wow. That's amazing. And just sort of thinking that through. So, people might turn around and say, well, shareholders, they're just out to make money. But actually, if you take a sort of sophisticated shareholder that's looking in totality, saying, do I want to, what is my perception of this? How sustainable is this business? And as we have then actually the traditional arguments that you might go, well, anybody investing in a bank is just out to make money. If you think about shareholders as being much more sophisticated nowadays, that's a really good proxy for sort of a societal response. It's the closest thing we have to being able to assess how is this damaging the business? Yes. And so what you've really looked at there and said, the stuff that is perceived by those who study this sector closely, because they wouldn't invest in it without doing that, who've looked at this stuff, they recognize that actually having women on the board will save you from the worst excesses, or they'll mitigate the worst excesses.
Indeed. This is what we have found. And is given us some ideas for the next project, because as you know, there is a lot of talk about ESG and sustainability and all these other indicators. So we want to link these indicators to the presence of women and the impact on misconduct. Again, because ESG indicators are very fashionable at the moment, but it's really difficult to, I know Bloomberg has an ESG index. They are trying to do things, but how this translates into the culture of the company is still something that we want to try and understand. We haven't done anything yet, so I can't give you any preview, but this is an area that we are looking into.
That's fascinating. And I was thinking, as we sort of there's lots of holes one could pick in the sort of process. I mean, the challenge you've got here is this is a shifting dynamic. Mm-hmm. Point one. So it's sort of there are for obvious reasons, limited data sets in terms of women in the boardroom. It hasn't been happening for that long. You've got the challenge, of course, that sometimes regulatory fines take time to emerge. So the incident will occur and then it may not become known about for some time. So if I take something like LIBOR, that's not an incident where it happens on day one and day two, it's publicly known about, and day three, the regulator sanctions. There's a time. So for all these factors, that makes it quite challenging. So what you've got here is a very initial view based on a shifting platform. And so I think it's fascinating when I look at the scale of, what you're trying to get a handle on is sort of the output what happens when we effectively when we make a behavioral intervention by certain species. And of course, the data sets that you've got are limited and restricted. That makes it, that must be quite difficult to study and think about, because as you've gone through and explained some of these things, it isn't, it's research that requires you to think very, very carefully about other factors. It's not a nice, clean piece of data and a clean, simplified data set. There's a lot of challenge and issues there. Now, that will get easier over time, but there's quite a lot of thinking required to go into the data sets. And I can imagine, sort of purists might look at this and say, but there's a million reasons why this isn't indicative. And so I'm really sensing that you've sort of thought long and hard about the dynamics that underpin this.
We have, and you need to try and exclude other potential avenues, which is what we are trying to do in various other tests. So, for example, we try to check, because we do cross-country studies, we look at banks from different European countries. So, for example, we control for women participation in the workforce. We control for the level of women education in a particular country, because one argument could be there aren't enough women on boards, but it's because, female participation in the job market is very low. Hence, it reflects the makeup of that country. And the other thing that you touched upon, this is evolving. So from the financial crisis to now is a different industry. Some things haven't changed that much and are still there to change, but a lot of things have embedded themselves into the thinking of bank managers. So this idea of, recruiting more females, of looking at equality. All companies now have an equality and diversity and inclusion manager. So all things that didn't exist prior to the financial crisis are becoming more accepted. So whether the changes that has been imposed by regulators is trickling down slowly, changing slowly the culture of companies, it remains to be seen. Also, there is a new generation of younger employees, and they expect more equality, more inclusion, more diversity. And similarly, the new clients are also expecting that. So it is a little bit push and pull when we see these changes. A little bit are imposed, but a little bit there is also market demand. And that makes me feel a little bit more hopeful that things will change. But I am also thinking that without the reforms and without the impetus from regulators, the change would have been a lot slower.
Right. It's an interesting point because very often regulators do things, and I'm, having been one, I'm very willing to criticize them, but also recognize the challenges they're under. So you look at it and go, and even implicit in the way I described it was sort of, well, they've imposed this thing and it's not this. They are sometimes required to do blunt measures to kind of push things along a bit. So the change that would have happened anyway, if I look at things like operational resilience, same topic. Firms are sort of, there's enough of an intrinsic motivation to do it, but if the regulator gives you a little bit of shove in that direction, you'll pick it up quicker, and that'll kind of have a snowball effect. And I'm really intrigued by your perspective on the regulatory tools at hand, because what you've done is you've basically said, okay, let's look at fines as a sort of proxy for the bad outcomes that we don't want. And then we'll look at a change that's happened internally, structurally, to kind of manage that. So I'm fascinated by one your perspective on fines and whether you think those more effective than actually some of these other pieces. Is it or do we need both of those things to deliver?
I think we need both things. What we were surprised was the amount of fines and the frequency of fines, and the fact that most of the time it was the same institutions over and over again getting fined. So it's not a secret. You can see who these institutions are, and year in, year out, they receive massive regulatory fines. And what is surprising still is the fact that their reputation hasn't suffered that much. So they are still out there, they are still doing the business. So the incentives for them to change are not quite as strong. So regulatory fines are important. They send a signal to the market. They make the headlines the day that they happen. But then we've seen that, bank share prices are recovering quite quickly. So that's why you need both. You need the regulatory changes, and you also need the fines sometimes to keep bankers aware that, there is also a reputational issue, and it's not just the cost of the fine. The cost of the fine, apart from a few, they are not that big for the institutions. Is more the reputational cost of being fined.
And as I look at the, one of the interesting things about, human behavior is it's driven a lot by the environment that we find ourselves in. So if you take the old analogy I always like talking about, sort of, if you have rotten soil, you can keep planting new seeds in there, but you won't grow the beautiful flowers that you're looking for. So the environment, and I'm fascinated by the idea. So you've looked at in very simple terms the way firms have responded to this pressure, both from regulators. Let's give them the benefit of the doubt, say intrinsic pressure as well, but our clients and everything else of having more women represented at senior levels. You could say, well, okay, that's parachuting that if the soil is rotten, in other words, if the barrel is bad that the firm, then just bringing these people in isn't going to make that change. Do you have a sense there of, is that a really powerful way, or is the fact that you get women represented on the board, does that help then change the nature of the organization and the soil? Because if the structures don't change within the organization, that's not going to change human behavior on the scale that we're probably looking for.
We have seen example of both. So there is this effect in the literature that is called the glass cliff effect, when the company is already struggling, is already dealing with poor press, and they have regulatory issues, they have reputational issues. They will try to have a very high profile female hire to say, look how ethical we are, look how good we are trying to redress the situation. And then, as you say, is already rotten soil, the company is already doing badly. This possibly isolated woman putting to deal with what is a failing organization will eventually fail. And then you will hear, oh, well, she couldn't do very much. But, women don't have, a magic wand. They cannot turn around organizations that are already failing. But if they are hired in organizations that they are not so troubled, and they can slowly change the culture, and they can attract more women in senior roles, because there is also this idea of mentoring. There's also this idea of women feeling more comfortable accepting positions if there are already other women. It's very difficult to be the only woman in a boardroom of 50 men.
Right.
You can do it, but there is also this reluctance in some circles. So if you manage to change this and you manage to hire more women and slowly change the culture, then you see when the results are coming. It doesn't necessarily mean that, and this is something that we stress in our research, we are not saying that women are a better manager. We are not saying that women are better at delivering results for shareholders. We are not saying that women are better at increasing profitability. And some of these studies that they go, oh, there is a gender quota. Let's see the profitability of banks. Let's see the return on equity. And, oh, we don't find it. First, it takes time. And second, I am not arguing that we are any better or worse. What I am arguing is that we have a different skill set. So given enough time, we might, be equally good, deliver the same results for shareholders, but we might go about it in a different way. And what you are really needing is a diversity of views. And what we have seen, especially now with the pandemic, that doing things the way we've always done is not helping. And the more agile, the more willing to change, the more the organization has different views and can be really agile in changing, the better it is. So there are a lot of pluses to diversity, which are not necessarily, but the return on equity hasn't increased that much.
And I love there was a great quote. I think it was Lenny Kravitz, and I'm not normally taking to sort of quoting rock stars, but he said something like, men have had a long time to have a go at this. Isn't it effectively saying, it was much more succinct, but it was sort of, shouldn't we try something else here? And I thought it was interesting when if you look at sort of political systems, and we're both based in the UK. So we have this, we've got one government in, and you sort of see this swing between one end of the spectrum and the other. And it's almost like the way we tend to vote new governments in is that, we've had enough of the other lot. Let's let they'll get back in. They check. And so there is this kind of cycle. So implicit in our psyche is we don't want too much of one thing.
Yeah.
And if you give electors the choice, there are plenty of elections where there isn't really a choice, but if you give electors the choice, typically they will throw people out after a while. You try the other, you just try the other gang.
Yeah.
And I think that's a fascinating thing here when one looks at it, sort of go, we've kind of doubled down on male leadership for a number of decades and centuries, and we haven't had a few historical examples proving the exception, if you like. That we haven't really had that opposite thing. So to my mind, it's sort of, you can't really start to draw conclusions as to whether it works or not until you've given it a proper go. And what we're looking at here is the start of that test period. So this sort of return on investment argument is a very short thing. You wouldn't be judging something on a very, very short window with limited data sets in another scenario.
Yes.
And yet people are to choose to apply. So I think we're sort of at a fascinating time where we're starting to tease that stuff out.
But if you think about it, there is quite a lot written, and I am not telling you this is the truth, but governments that were led by women during the pandemic, and the example is always New Zealand, but also to a certain extent Germany and other countries seem to have done better, or at least the perception is that they have done better. Then maybe it wasn't, but the perception that they were more compassionate, that they tried better, that they tried to explain things. So the popularity of the New Zealand Prime Minister is incredible. And, the way they have done, of course, it's a small island, small population, and we all know the caveats. But there is this challenge and say, there are now a few women head of states, and during the pandemic, they seem to have outperformed.
That was the question I was going to ask you. So I know you obviously focus on financial services, and so so I'm not asking you to be an expert in other. But do you, as you've looked at this, do you think what you're exploring here is a financial services specific dynamic? Because I don't know, the nature of the industry, the history of it, the reward system, all is some of the things you've looked at here applicable in a broader piece, or is the scale of is what makes it fascinating the unique dynamics of banking?
Banking has some unique dynamics. So banking is all about risk taking. Banking is an industry that has been built on solid nerves, risk taking, being quite ambitious and challenging, and the financial industry has very specific characteristics, and I see it with my students, attract a particular type of personality. So men and women alike, you wouldn't choose a job in the financial industry if you really didn't want the stress, if you didn't want the challenge, if you didn't want to push yourself. So it is a specific case study, and it doesn't apply necessarily across all industries. There are industries that look for more creativity, they look for different type of social skills and so on. So there are issues that are specific to the financial industry, and the fact that there is a lot of money at stake. The risks are very high, the regulation is very high. But some of these issues can be applied, if you want, to other industries and other management. So the lesson can be transferable. So if we have more women in leadership position and we bring about a more diverse view and a more balanced view of how to manage the company, it can only be a good thing.
And as you were talking there, I was thinking, all of these unique dynamics, it's really interesting because I think if we were starting again with banking, let's say banking never existed, and you were trying to set it up nowadays, a lot of the dynamics that are there in terms of the pay scale, just some of the processes, the way that the sector operates, the very reason that you need it to be so heavily regulated, you wouldn't start from there. And you probably wouldn't be allowed to build something up along those lines. I mean, I'm now thinking social media, which arguably crept up on us in a similar way. But you wouldn't be allowed to start to build something that has those particular dynamics. So there's a fascinating piece here that sort of says, in many respects, what it comes inbuilt with there's tremendous benefits, right? I'm not going to dispute, but it's got a heck of a lot of flaws to it.
Yes.
In terms of how it operates as a sector. And so what we're looking at doing here with these changes and the regulatory is to sort of curtail something and control something that in many respects is out of control and that you wouldn't be allowed to do if you were starting again. And it's fascinating to look at it because actually I wonder whether the introduction of sort of greater diversity in the sector is going, and I mean that both in terms of younger people coming in and questioning why we do things with a different perspective on life, but also bringing diversity in, is actually going to change fundamentally the way the industry operates. Because I think if you looked at it and said, how can we justify the pay levels, the systemic nature, you wouldn't allow that to happen. So I wonder whether inserting some, for want of a better phrase, fresh blood and fresh thinking is going to shift some of those fundamentals, that the sector won't look the way it is, not because of society, but because it comes from within.
These changes are already happening. I have a lot of contacts with employers, and they say that they struggle to recruit and they struggle to retain talent, that a lot of the youngest employees coming is no longer, I want to work for this bank and work here forever. It's more, what can you do for me, rather than what can I do for you? So and they are more interested in the environment, in social responsibility. So there will be changes coming from the new generation coming. Other changes will come from technological developments, the new challenger banks, the fintechs, the fact that some of the monopoly of banks has been eroded. 10 years ago, before the crisis, all my students wanted to go in investment banking, become rich and retire by the age of 32. Now they know that is not the case anymore, and you see them being interested in a wider array of careers, going from compliance to mergers and acquisitions, but also in payments. Payments used to be so boring and is super exciting at the moment. There is so much happening in payments. So the interests are different. You still have the student that wants to become a trader and still has Gordon Gekko as a role model, but this is changing. Yeah,
it's funny, isn't it? You sort of look at it and go, is Wolf of Wall Street and Wall Street are those now sort of recruitment movies, or are they things that put people off? And I think it's really interesting. I think historically you would have looked at it, people go, that's a very appealing piece. I think that the number of people that would view that as a positive role model
back then, yes.
Right, yeah, it's rapidly declining. So final question, you've sort of alluded to it, is what's next? What's your next sort of area of exploration? What are you up to at the moment?
So at the moment, we want to look more into these ESG indicators to look if, misconduct is not just the financial misconduct, but these companies that are more prone to misconduct are also breaching environmental regulation, are also breaching labor regulation. They are also in trouble for other type of misconduct. So we are trying to widen the idea of misconduct, not only still looking at financial misconduct because it's the main thing that we want to look at, but broadening the definition of misconduct. For example, environmental responsibility has become more important. The Bank of England now is running even the stress test on climate change. So we want to look at broader aspects of conduct risk and still link it with gender and with diversity. And the overall idea is to see if broader diversity measures and gender diversity in specific can help a company behave better in a more, if you want, holistical way.
Fascinating stuff. Listen, that was, I thoroughly enjoyed reading the research. I've thoroughly enjoyed speaking to you. Thank you so much for both things.
You're welcome.
I will put links to all of those things in the show notes because I know listeners are going to want to dive in and have a look at what you're doing. And we will keep a close eye on where your research takes you because I think what you're doing is incredibly important. So thank you for sharing that with us.
Thank you for having me. Bye.
So that's it for another episode of the Human Risk Podcast. My enormous thanks to Barbara for appearing and to you for listening. To find out more about Barbara and her work and to read the research that we discussed, have a look in the show notes. There are links to both of those things there. If this is your first time listening to the Human Risk Podcast, welcome. You can subscribe wherever you get your quality audio content. It's available on all of the major podcasting platforms. If you like the show and haven't yet left a 5-star review, please do so. It really does help. If you're interested in finding out how I can help you mitigate human risk in your organization, do visit human-risk.com. I'll be back very soon with another episode in this series, but in the meantime, stay safe and thanks for listening.